their country's falling apart. I mean,
Yeah.
the currency's getting smoked, the equity's getting smoked, and now you got the supply chain stuff. I'm sure they did it for some kind of internal power control thing, but like, yeah, you don't. That's a drastic move. Martial law.
Right.
It,
Yeah.
they were claiming that the opposition was stirring up political unrest, and so that's why they.
Yeah, exactly. They can do that if domestic, that's an exporting nation. So if you have your currency tanking and your stock market tanking, and now you got the tariff man coming in, and it's just a lot of stuff going on. And plus, as we know, China's weak. Like, I don't think things are good there. Let's put it that way.
Mhm.
It's a good time to have a political upheaval when the people are upset because the economy's not good.
Yeah. What is their biggest export? Auto? Is it the auto industry? I can't remember now. But I mean, if you look
electronics, auto, semiconductors, like all that kind of stuff.
yeah, I mean, if you look at the charts of Stellantis, the charts of Volkswagen, it's just death.
Well, Stellantis CEO stepped down yesterday.
Right.
Yeah. Machinery, chemicals, metal. They do iron and steel, energy, electronics. I mean, it's a pretty developed economy. Like, it's that's a first world economy.
So, did you guys see the Twitter chart that showed I think it was BMW or Mercedes model sales of a certain model in China last year, and by month over the last year, and it went from like thousands to hundreds to tens to zero units sold. I don't know if there's any model changeover or issue, but it was saying that the European automaker are just starting to feel the.
Oh my god! Well, you know why that is? The goddamn ECB. The ECB was such idiots. Hey, are we retweeting this, Jen? By the way.
Yes, I'll send it to you in a minute.
Yeah. Okay. Yeah. The ECB was doing QT and just artificially keeping up the euro, and finally they just had to throw in the towel as the Trump reality came in. The euro's going to 90 cents. That's the only. I mean, like the DAX is actually hung in there okay, but like, the European economy is going to take a year at earliest to get any kind of recovery. Like, it's just a disaster what they did. Like, the European economy is an outright disaster. France might lose its government tomorrow.
Mm-hmm.
Most of my macro guys, their biggest trade on right now is mega short euro yen and mega short sterling yen. Like, which is the same trade, just, they did the Brexit and they have all that. But like, yeah, I'm telling you, the yen is ripping, the dollar's ripping, and the rest of the world is tanking. And I just don't think that an S&P at where it's at is paying attention to what's going on outside its borders right now. I mean, I know that like a lot of money's domestically flown in because everyone wants to own dollar assets, but man, whew. Hey, Bob, what do you think about the OPEC headline out this morning?
Well, they deferred their meeting to the 5th. What was the headline this morning?
I can send it to you, but basically the gist of it was they're thinking about delaying the January hike.
Yeah, no, that's what they had said before. They're going to have the meeting on the 5th. They were supposed to have it on the 1st, but it conflicted with something else, and they moved to the 5th. And yeah, no, they're definitely going to extend that. That's without question.
They have to. They have to, right?
Yeah, they want to keep the oil price up here at closer to $70 a barrel.
Right, because I mean, there's just a glut right now, and again, I know Robert doesn't think they're drilled baby drill, but I talked to some guys in Texas who are into like smaller independent guys, and they're like, they're sniffing out that some leases are going to come due. Well, if they give capital to guys, if guys can raise capital again, I mean, that's the thing. Like EOG and Devon might not be in the business of expanding, but like the other guys can just, we got 5,000 barrels a day, 8,000 barrels a day. Like those kind of dudes can get back in the game.
Yeah, that's exactly what we said on here on this show a little over a week ago, that this may free up some private capital to fund some of these smaller private deals or smaller E&Ps and now go out and try to ramp up. But it's not going to affect the big public companies. They're going to stick to their discipline. But how much does that move the needle? I don't know. We'll see. But in the meantime, China's weak, and that's hurt things on the demand side, as you pointed out.
Yep.
So are we starting now?
I don't know. Yeah, let's. I can't see. Okay. All right. Here we go. Welcome to Wall Street Beats. It is December 3rd. The Advent calendar has started. We have Robert Marcin, Charlie Peabody, and Mr. Oil himself, Bob Morris. We're coming at you
Slippery guy he
at
is.
it's just a little after 10 a.m. Eastern. All right, let's get it started. Robert, why don't you tell us what's going on with Elva?
Oh, well, I wasn't doing Elva, but Elva got a big
Oh,
order.
I thought that.
Electrovia got a big order today from somebody. It's a big retrofit project for a leading U.S. discounter, which means it's only one of probably Target or Walmart, which is a good thing. And it's my little battery company, the Canadian battery company that has the kick-ass IP. And it's just another sign that they're starting to do what they say they're doing. So stay tuned for further developments there. The company I did want to talk about in more detail is a stock that's Chart Industries. Hit my screen, hit my formula, my discipline over the summer. We bought it in the 110 to 115 range in decent size, and it's 190 now. And a lot of stocks have done that in the last 3 to 6 months. I'm not patting myself on the back for that, but when you buy cheap stocks and they do that, you can still hold them. They don't become expensive quickly. You don't have a valuation reason to sell. So I was just scrolling through I haven't talked about this since the election, and this company went from being one of the most conceptually unattractive companies under the Harris and Biden administration because of what they wanted to do with natural gas and LNG production, to one of the most attractive in the energy patch because of what Trump wants to do. Not with drill baby drill oil, but with, I believe they're going to really incentivize natural gas exports, especially to Europe and to other friendly parts of the world, non-China, Southeast Asian places like that. So I went into the slide deck that they had during a capital markets day, and the company said they own one of the two major LNG process IP portfolios, and they have a different way of doing LNG than the Conoco formula, which is just to upscale everything. And these guys do smaller modular units in producing LNG. And they had a slide there that said they have 15 projects underway around the world. There's 6 that are announced but not yet underway, and there's dozens that are under discussion. Dozens. So if you pick 3 as a sort of 2's a minimum, I'll give them 3. That means somewhere between 25 and 50 projects underway for big LNG for them, and these are multi-$100 million projects. So the fact that the U.S. now can start, generating real project work. I think a lot of these things were on hold while the election was ahead of us. But now that the election settled and you have at least 4 years of very friendly LNG support from the administration, where is the energy going to come to produce the electrons, right? People want to pay they want to pay 26 times EBITDA for Eaton because they make the machines that make the electrons. That's fine, or manage the electrons, right? But if you have to have fuel to make the electrons, and the rest of the world needs power too if they're going to put any data centers abroad to take advantage of AI. And the U.S. companies that make electrons, they don't have any exposure to that. But this company is truly an international company, and I would suspect that they'll get a decent amount of business for natural gas production around the rest of the world to support the demand for electricity in foreign countries as well. So to me, this becomes a very conceptually appealing stock. So I had to see what the valuation was because the stock's up 75%. And that's for a value guy, that's a good trade in a few months. Sometimes we scalp them, right, Ben? Sometimes we take a freebie like that. And yet here I looked at the numbers. It's 10 times EBITDA for 25, 10 and a half, which is less than half of Eaton's. And it's like 13 times my estimate for earnings, which is half of Eaton's. And, it seems to me that this is sort of, if they start to make the numbers, if they start, they haven't had a beat and raise since I owned the stock. If they start to beat and raise, the stock is, could potentially, go up another 50 to 100% from here over 2 years if they hit their internal targets, which are 15% organic sales growth and significant margin expansion. So I'm not even thinking about selling this stock, even though it's overbought. I wouldn't buy it right here, right now, because it's overbought. But if we get
Yeah.
I'm thinking we get a first. I'm even thinking of shorting, Ben, all these electricity related Momo plays the last week of the year for 2 weeks, just to see what happens when people start taking profits and the calendar rolls over. But I wouldn't short this. But the PAL Industries of the world and the Vistras, I'm thinking about going back short in those ideas for 2 or 3 weeks into January. And I wouldn't short chart, but I would buy it on a 15 or 20. I would add to my position on a 15 or 20% pullback in the first quarter. And this beta has got to be 3. So you don't worry. If the market went down 7% in the first quarter, this would go down 20%. So it's just that volatile a stock. So I would I'm gonna watch and see what happens with this first quarter. The crashette never happened for me, Charlie. So now I've moved on to the first quarter seasonal cyclical pullback that generally happens post-election, and hoping that's going to deliver this time for us. And just a lot of people wanting to lock into a lot of big profits in individual names for 2024 once we flip the calendar over. So charts on the list to add on dips. It's up a lot, but it's still very cheap compared to its competition in the space. And it's just become, much more interesting as a conceptual appeal stock now that big LNG is back on the market bigger than ever. So I'm going to need to come up with an acronym for that.
I mean, we did get a crash yet. It just crashed up instead of down.
Well, when you get the sign wrong, that's when you're wrong. No matter, you are right.
Just saying. You just saying. We did. We technically
we
did get a crash up. This chart. I was involved in this in the 2016 to 2019 period, and it was just such a hot stock back then. Mm-hmm. And that was a great call by you. When was it? September, October, when you were telling people to buy this around 120?
Throughout the summer. No, it went. Remember, they missed the first and second quarter, and the stock went from 190 to 110. So, I mean, but they were still growing the top line in the teens and still talking about teen growth. So how could you pass? I mean, it was 5 times EBITDA at that point, 5.5. And again, everything else was a lot more expensive. Chart, I've looked at chart for 15 years because I like that business. I like process.
Oh, it's good. It's good. It's good.
IP. I mean, it was always a very expensive. Never got cheap. For 10 years, chart never was cheap. Traded at 30, 40 times earnings for a decade. It was stupid. I got my chance when it went to 8 times earnings and 5 times EBITDA, and I bought the stock. So I would hope I can get lucky enough to have it get expensive again.
Yeah. Okay. I mean, so where are you buying? Where would you buy? Like, I'm looking at the chart right now. So I see what you're saying.
I thought Banksy was coming on to tell me where I was going to buy it on the chart today.
Yeah.
We'll follow up tomorrow.
I want to, as you can see, it's straight up, right? It went straight down, straight up. I mean,
yeah, it's a very erratic. It trades very erratically. Like gets to this 200 level, and
it's
then
kind of thin for a mid cap company, and it's got a lot of short interest. And
I
that,
mean, this is actually a fantastic trading stock for the last 3 years. You know, you sell it above 180, 190,
buy it at 120.
and buy it at 120, and like
Yeah, you could have
you've
done it
gotten a
3
lot of
times.
runs at
Oh,
you gotten a lot of rides on that carousel.
yes, and that's why at 190 I'm thinking, do I need to take my profits here and buy it back at 120? And I'm tentatively concluding no, but and I'm also hoping that there's a pullback. I don't know, 160, 170, 170 maybe from 190 if the market goes down, so something like that. But I would buy more.
Okay, well, good, and that's been a good stock call. Good job, Robert.
Thank you.
Charlie, what do you got, buddy?
Well, I was going to highlight some macro issues that I think are supportive to the market into the new year, and that's not new. I mean, everyone's expecting to grind higher into the new year, but the FOMC minutes were released last week, and there were two items in those minutes that didn't get a lot of popular press coverage. And they both related to the management of the Fed's balance sheet. Um, and the first one was a recommendation by the staff that they lower the overnight reverse repo rate from 455 to 450. Doing that would put it at the lower bound of the effective Fed funds rate of 450 to 475. And the implication of that is two possibilities. One is there's been some recent pressure in overnight money market funding, so they may want to lower that to alleviate that pressure. But the other is, that it's an indication that they still want to lower rates going into December. So it favors another 25 basis point rate cut in December. And so, I think lower rates obviously are going to be supportive for the general investing market. And that's one signal that, they're considering cutting these technical levels, that they want lower rates still further. So I think that's supportive. This is the second item that the staff addressed in their meeting with the board was the idea that we're facing a debt ceiling in January. And so they're preparing for that debt ceiling and recommending that they draw down what is called the TGA account, the Treasury General account. And that's around 800 billion right now, and it can be drawn down to under 400 billion quite easily. So there's a fair amount of liquidity that's going to come into the market without incremental issuance if we hit that debt ceiling. And so that additional liquidity that is likely to come in between now and the January argument is going to be supportive to the market. So I think those two items support the idea that we're going to grind higher into the new year. From my industry perspective, where I follow the banking industry, there are two names that I would play into the new year. My number one pick continues to be Citigroup. It's trading at 72 right now. I think fair value going into the new year is somewhere between here and 78. With $100 still my target for early 26. In terms of the advancement of that story, Citigroup did complete the separation of its Banamex Mexican consumer banking franchise. The physical separation was completed here just a week ago. They now have to run that operation for a full year, and then they can spin it off in an IPO towards the end of 25, early 26. And that will be a big capital raising event. They should be able to get somewhere between $7 and $10 billion in an IPO for that operation. So Citigroup remains my number one pick here. But the other one that I want to highlight is Citizens Financial, CFG. Now, I want to be careful here because the banks had one of their best months ever in November. I mean, they were up 15%. So that's a good year in a month. And so some kind of pullback and backing and filling short term is not, wouldn't be unexpected. But I think Citizens Financial can be bought on that pullback. And there are a couple of things that I like about CFG. First of all, they have very strong capital base. They have a 3.5% yield. They'll probably raise that dividend in the third quarter of next year. by high single digits. If we get a tax cut, it could be a low double digit increase. They're buying back about $200 to $300 million of stock per quarter, which is about 5% of the shares outstanding. So that's attractive. They are a regional bank play on a capital markets improvement, because they, over the course of 20 to 22, they bought 3 different capital markets franchises. So they've really improved that. And they're a play on wealth management, because they picked up the First Republic wealth management operation when that went bankrupt. They're one of the cheaper regional bank names. They traded only 1.4 times tangible book. They trade at 12 and a half times earnings, where the average regional bank trades at 13 times earnings. So I like it as a valuation play. I like it as a position play. Oh, one last thing. They are a beneficiary of low rates, so it feeds into that idea that the Fed's going to cut in December. So that should help their net interest income or top line revenues. So Citigroup and CFG are the 2 names that I would play into the new year.
Okay. I mean, when you think about that Banamex, what's the value that you're ascribing to that as a percentage of the market cap currently?
Citigroup's market cap.
No, the spinoff. Like, what's the spinoff percentage of the market cap currently? Because when we do these things, like, I remember the best example was, you guys remember Yahoo, was a darling in the 90s and early 2000s. But what really saved them was that they made an investment in Alibaba. So around the time Alibaba came public in 2014, 90% of it was, so there was like a great stub arbitrage there. So I'm just curious, like, what percentage is this Banamex of the Citigroup market cap in your mind?
It's about a high single digit.
Okay. So it's material, but it's not like 30% or something like that.
No.
Okay.
Okay. And in the meantime, it's a good earning franchise right now, in its contribution to Citi's earnings power. But the key there is Citi is trading at 80% of tangible book, and if they can raise capital, they can be buying back 5% of their stock at a discount to book. So it's accretive to book value. And I think they can, the accretion to book value is they can have the stock trade at 1.5 times book and it still be accretive. So buying back stock at Citi is a real high priority for that franchise as they build up their capital capacity.
What percentage of Citi's assets are non-dollar denominated? Do you have any idea on that?
Ooh, it's changing because they have been exiting their international consumer banking franchises as part of their effort to simplify the organization and free up capital. So they've retained all of their corporate international assets and disposing of their consumer banking franchises. So honestly, I don't know off the top of my head what it is today, but they're becoming much more.
Is their funding mostly dollar? Is their funding mostly dollars?
Yeah,
or is their
funding is mostly, yeah, absolutely. But
Okay.
they have benefited as foreign central banks have cut rates on the international franchise as well. So they've been a beneficiary of both the rate cuts domestically and internationally.
Right. And let me ask you one more follow-up, and then we'll move to Bob. I think you saw that I sent you about France maybe losing the government tomorrow. And obviously the oats bun spread is really blown out. And it's funny, yesterday I had a guy that I was talking to, and we were looking at that 10-year bun spread versus the 10-year U.S. Treasury spread. And it's blowing out, and the yen's, or not the yen, the euro is kind of just really weak. And I looked at that bund, and it was negative 85 bips in 2019, the 10-year bund. And so you wonder, how many bad assets are European banks sitting on? Because if you were buying, some of the paper in 18 and 19 that's at negative rates, it's not like rates are that high, but like those guys are sitting on insane losses on a mark-to-market basis, right? So what happens if their funding gets a little disrupted here, or they have US dollar denominated debt as well. And as the euro trends towards 90 cents, I mean, doesn't it seem like the European financials could be the epicenter of anything that's going to happen here?
Yeah, if you look at the spread between the European, what is it, the SXS7, their bank
Yep.
index versus the U.S. bank index, it's incredible. You've got, the European banks going from upper left to bottom right, and you got U.S. banks going from, bottom left to upper right, and that spread has gotten quite substantial. And I think you're right. What is it? The French oats spread to the German Bund is around 88 basis points right now. It's breaking out to new highs. So there is no question. There's real concern about obviously the government and the budget, the inability to come up with a budget that's good. But that reverberates back onto the French banking system. And the one thing I will tell you about the French banking system, they are one of the biggest players in derivative structures. And if there is any dislocation in the French fixed income markets, it's going to hit French bank balance sheets pretty hard. So I think there's reason to be concerned. And the real question is, usually when things develop, in a dislocated manner in Europe, they eventually wash up on our U.S. shores through that derivatives market. And that's something I think bears watching, particularly if we have one last, blow off move into the new year. Then I'm going to adopt Robert's attitude about, somewhere in the first quarter, you want to be careful about, another crashette.
Crashette down this time instead
Down.
of up. All right, that's great.
I think that the winds are favorable into the new year. So, as far as I can tell.
Yeah. I mean, look, I look around and there's a lot of things that are slowly, creeping up outside of the shores of the U.S. that
Exactly.
I think are worth mentioning. And again, a lot of U.S. equity investors kind of are myopically focused on the S&P 500 and their portfolio, which is some combination of U.S. stocks. So there's a lot going on beyond our shores. It's a nice time to be in America and own American assets. But it also was a nice time to do that in 1999 and 2000, just for reference, and the late 60s and early 70s.
If you look at any of the international indices, they're all been rolling over for the last 2 or 3 months.
Absolutely.
So the money's coming here, and that's why I think we're still having one last sort of, melt up.
Which is exactly what happened in 2000. In 2000, if you remember, you have a 1997, you have the Asian crisis. This kind of smells like that a lot, what's going on right now in Asia. In 98, you get the Russian default, and you get the long term, and then the Fed had to pause, and they juiced it a little bit. And then all the money from around the world came into the U.S., and we get the blow-off insanity that was Q1 2000. And then, you have a rollover. And look, not to be a Cassandra, but I would say if you look at Bitcoin, you look at MicroStrategy, you look at just the S&P trading at 25, 26 times, there's a lot of things that kind of parallel that, I guess. And just one last thing, the BEA came out with their quarterly Q3 preliminary corporate profits down 30 basis points year over year. So Wall Street is telling you a different story than the government is on what the corporate profits, and that was something that happened in the late 90s, 2000 as well. So I'm going to put that there, and we're going to go to Bob and talk about some energy.
Just one last observation. I was always taught, on the currency market to watch the Indonesian rupee as sort of a broad gauge of what's going on with Asian currencies, and that's cracking. And then on the indices, go ahead. Sorry.
Yeah, no, I was just going to say they all are. I actually tweeted that out this morning. The thing that's going on now, especially, is the yen is starting to really take off. There's bets going on. They're going to raise December 19th at the BOJ meeting. The long end's kind of trading up. So those yield differentials relative to the rest of the world are compressing. I had talked to a guy yesterday who told me he thinks dollar yen's going to 100. And so if dollar yen goes to 100, and the dollar is sticking around where it is here relative to everything else, it's going to be very difficult to see risk assets stay at these elevated valuations. Let's just put it that way.
Yeah.
But anyway, all right, let's go to Bob. Let's talk about some energy. Bob, what do you got, buddy?
Thanks, man. Well, following on Robert's play on Chart Industries as an LNG play, I'm talking about Expand Energy this morning, which at the beginning of October, when they closed the merger with Southwestern Energy, their headline was LNG ready. And the key here is that they're the largest natural gas producer in the U.S. now, and they don't have any LNG contracts locked up yet, but they're looking to lock those up given the size of natural gas production they have. But I'm keeping a close eye on Expand Energy because it's one of the pure U.S. natural gas E&P plays here. They're 91% natural gas in their production. That's second behind EQT at 94%. But I think a lot of people have overlooked this name. This is the former Chesapeake Energy. And so what happened was they went through bankruptcy. They came out of bankruptcy in February of 21. They brought on new management. And in October, at the beginning of October, they completed the merger with Southwestern Energy and changed the name then to Expand Energy. And the 5 key points I'd make here is one, the management here, Nick Delosso, who was formerly the CFO, tapped by then Aubrey McClendon way back when it was early days of Chesapeake Energy, is now the president and CEO. And this is a former Wall Street guy. He gets it. He's very, very sharp. I like
Very
Nick,
sharp.
and he's doing the right thing here with the company and focusing on the right things. I really like Nick. I think he's extremely sharp here. 2, Expand is now the largest U.S. natural gas producer. They're nearly 6% of total U.S. dry natural gas production. Third, among the pure play E&P gas focused companies, they've got the highest base dividend. And as you know, in my portfolio, I like a high dividend. Their yield is currently about 2.3%. Next in line is EQT at 1.4%. So that's a very nice dividend. And I think that dividend is safe and will stay in there. I'm not worried about the dividend. The fourth point is with this merger with Southwestern Energy, they raised our target for synergies when they reported third quarter earnings. But I think that target is going to increase further in 2025. So I think there's going to be further upside to the synergies they realize and the capital efficiencies they realize in this merger with Southwestern Energy. The fifth point is that while their production in the third quarter was 6.75 BCF per day, they then had curtailed about 0.2 BCF per day due to low natural gas prices. And they say they have productive capacity of nearly 1 BCF per day. And what that is that's drilled but uncompleted wells or completed wells are waiting tie-in. So some of this is short cycle, but they've got a lot of production just sitting there that they could turn on with a flip of a switch. And their maintenance program officially for 25 is for 7 BCF per day. But in a $3 to $3.50 natural gas price environment, they're going to have a lot of excess free cash flow. And they'll target that first to reducing debt by about $500 million. But then they're going to look at either bringing online some of this productive capacity and or repurchasing shares, which they have $1 billion authorization for right now, and or paying a special dividend on top of that base dividend. So I think they're very well positioned with regard to the longer term fundamentals for natural gas. Now, as you know, we've been somewhat cautious on the natural gas names near term, just given that if we have a normal winter, which is what everybody was forecasting starting out the winter, with the year-over-year natural gas storage overhang and with the recent run-up in gas prices, we've been somewhat cautious. We think, apart from any weather-driven spike, that the ceiling for natural gas is about 350. We sort of bounced up close to that. We're back down closer to 310 right now. 2 weeks ago, I said I initiated a 20% position in EQT just to have some exposure here going into the winter. I have not added to that. I've not yet bought Expand Energy, but as you know, our long-term view on natural gas is still very, very strong. And that's because we see toward the latter part of 2025, this acceleration in LNG projects coming online and with the bailed out of AI-driven power center demand. And so with a longer-term view, I want to own these gas names. I've been cautious here. I still think it's a little bit early unless we get a super cold winter. I've not yet bought Expand Energy. I'm very intrigued by it. Them and EQT are the names that I would buy first, but I haven't. I'm sitting here watching and waiting for the right time to step in on Expand Energy and to add to that starter position I've got on EQT. But I'm very intrigued by Expand Energy and like this name a lot.
And what is, Robert, you can chime in here too. What is I can't remember. What's the exact layout or progression of how these LNG BCF come on? So I think we have like 12 or 13 by
Yeah,
in the
we've
next
got
18 months, right?
12 to start to come online later this decade. Now, it's interesting. What the Biden administration had put a pause on or stopped was the approval of any new LNG projects. So beyond those 12, which, what you were talking about then was way beyond 2030. So
Yeah.
with Trump likely to lift that ban on new LNG projects, you're looking pretty long term, as probably out a decade as far as any new big projects that have yet to be approved that would then be constructed, funded, come online. But there's quite a bit of LNG in the pipe projects, export projects coming online here, beginning in a few years that then will extend over the next decade. And the one thing that Expand came out and emphasized was, again, when they completed the merger with Southwestern, was that we're LNG ready. So in other words, they're ready and they've got this huge pipeline of natural gas to sign up contracts or to provide that production to these LNG export facilities. And it's good being the largest natural gas producer because you've got a lot of backup. You don't have to worry about a pipeline going down or wells going down anywhere that disrupt that production. You've got enough production to backfill if anything goes wrong anywhere. So they should be the source of choice for any new LNG projects.
Yeah, I
Instead
mean
of
12 BCF.
Ben, instead of
Go
drill
ahead.
baby drill, it's liquefy baby liquefy. That's the new thing.
Yeah, I mean 12 BCF is a lot of gas, right? Like we're not talking about a small amount of gas that
Well,
coming
it's
online.
12 projects. There's even more gas than that, but where total U.S. dry natural gas production runs around 103 BCF per day, plus or minus.
Right. So you're talking about 12% export capacity coming online. It's material.
It's
That is
huge.
over
And the
here.
one thing you have to worry
Yeah.
about at some point, do we have too much? Just given.
Yeah, we got to show, and that might be one of the things that Trump's doing right now, right? Because everyone's like, "Oh, what's he doing?" He's going over and beating guys over the head with the tariff stick, and probably saying, "Hey, we're going to need you to buy some LNG. We got 12 BCF coming online. How many orders can I put you in for?" And by the way, that's another dollar positive thing, but like. I mean, no one likes natural gas right now, Bob, do they? I mean, like, is there any sector that's more hated than natural gas?
Well, I don't think it's hidden. I think everybody's waiting. They want to own it long term. They just haven't stepped up yet.
Yeah, yeah, yeah,
I
yeah, yeah.
mean,
So we're in that
I think,
weird like pre-event, I've seen this in crypto with Bitcoin. Was like, oh, it's coming, but there's no buyers now, and then when you get there, all of a sudden everybody shows up, type of thing. When that
and when
is
you've
that?
got this AI centered demand, some companies have been talking about buying small nuclear reactors, and that's not coming in anytime soon. What they're all going to realize, near term, our only choice is natural gas to provide the power to
Oh,
run all these data centers.
they're not going to run.
Absolutely.
They're not going to run them off of wind farms and solar farms. I'll tell you that.
No, we're
No,
not going to have
no.
these small modular reactors. We're not going to have those fill the gap either.
Well, I remember in the last cycle when GE's had the big combined cycle nat gas power plants that they were selling to everyone, and it was like, that was a big push for those guys. And I just don't see how natural gas just isn't continuing to grow both domestically and internationally over time. And if you look at the charts, they're pretty much linear, secular growing in terms of demand, right?
Yeah,
Yep.
I mean, it has to be near term the fuel of choice. There's no question about it. You're not, like Robert said, you're not getting it from renewables or small modular reactors, any of these other things.
Yeah, and so they get the headlines, but the reality is this is a nat gas country. So and we're lucky because of it, right?
Right.
I mean, think about how much nat gas has grown since '08. Whatever you want to call it, the beginning of the shale revolution, if we will. Like it's really been if you want to credit something for this bull market of the last 15 years. It's shale and bringing on all that nat gas and now we're exporters of oil, right? I mean,
Right, we're net
it's just
exporters. We're one of the biggest. We may now be the biggest exporter of LNG. We export it to Mexico. We put it down in through the Gulf, through the Panama Canal, and come up on the west coast of Mexico. I mean, it's insane.
right. Is there anything else in the energy space, as we look into this OPEC meeting that's interesting, or do you kind of is your expectation on oil just that we're going to kind of just be range bound, and you want to look at companies that are doing the right thing for shareholders?
Yeah, and I think OPEC sees what we talked about a couple of weeks ago, that it's a lot easier to make a bear case and a bull case on oil right here. And that's why I think that at their meeting on the 5th here in 2 days, that they'll again extend that increase in some of the, or lifting some of the shut-in or curtail production, pushing that out another 3 months in January, because they want to keep the oil price up here closer to $70 a barrel. And they need to do that just given the supply demand situation, particularly with soft demand out of China. And so I think you'll see that announcement on Wednesday. And I think investors will be a bit relieved that that's going to go toward supporting oil prices here, and continue to own some of these oil names that I like EOG and CNQ and Chevron and Diamondback. I would still own these names and be aggressive buyer on any sharp dip in any of those names.
Yeah, and I don't think they've been very popular. So, it's like Charlie's Banks were so unpopular, and then all of a sudden, and then we almost have a bank run in Q1 23, and it's been an unbelievable run for those stocks since then, right? And
Well, I
maybe
mean,
we'll have.
they're becoming a lot more popular because they've maintained this discipline over the last 4 to 5 years. And this is the reason you're not going to see drill baby drill, because these large public companies are going to stick with this discipline of spending within cash flow and keeping production flat, maybe up slightly, but they're going to continue to generate a lot of excess cash flow. Their dividends are safe. They're going to continue to buy back stock and or pay special dividends, and they're going to continue to generate these positive returns. And they can do that all the way down to $40 a barrel. I mean, you look at every single company across the board, their cash flow break even is close to around $40 a barrel. So in the meantime, between then, it's $60, $70 a barrel. They're going to have a lot of excess free cash flow. They're not going to ramp up production. They're not going to go drill baby drill. They're not doing that. We know that. But they're going to generate this excess cash that they're going to return to shareholders. And I think they're getting more and more appreciation for doing that. They're becoming a safer and safer, even though they're dependent on the commodity price, which is volatile. They're becoming a more reliable source of dividends or return of free cash flow to shareholders that investors like. And that's consistent, and that's been a very big positive for these names. And I don't think they're expensive here.
Yeah, I'm totally with you, and I think Robert would agree with you too, right, Robert? You're a fan of these names.
I'm a little more selective in owning commodity stocks, but it does provide a window for my select water to keep on working and to get a bounce out of weather for too long as I have there. Other than the MLPs, which have been in nice bull markets, they've been great stocks. So, and they're still very cheap relative to the C corp midstream companies.
Yeah, so let's just finish with that actually, and if Bobby, you can jump in because I know you've talked MLPs too. So I've owned ET for a long time, and we're now back to the 2018 levels. Okay, so we're at 1950, and it's a long way from March of 2020 when ET was at $4 and EPD was at $16 or 15. I don't remember what the exact low was. They've been fantastic, a fantastic 4-year run. And so, what do you guys? Yeah, so forget about the C corp versus K1 MLP differential, because I'm not sure that ever closes. I think that's just a gift for Americans that you get this extra risk premium because certain guys can't hold it. Everyone hates a K1. But just what do you guys think about MLPs now? Because we had such a run, and their valuations are not close to as attractive as they were. They're still okay relative to maybe a broad market. But do you guys have any views? Are we kind of like in that hold, or are you starting to get nervous that we're over our skis in the short term?
No, I still like him. I know Robert owns ET. My preferred name is Williams, and I've been looking for any dip in Williams not to it, but it's continued to move up since I bought it, this past summer. So I still like Williams. Honestly, I did add a little bit to Viper Venom, which is a royalty trust name to spin out from Diamondback. So I wanted a bigger position in that. So I actually added yesterday a little bit to that name on it being down, but I would still be in my portfolio, Williams and Viper, the two basically MLPs that I own, and of course Robert's ET I like. I just preferred Williams over that, but I would still own these names.
Do you prefer Williams just because it's a C corp, or do you just like it because of the Transco?
Because of the C corp and because of the build out of the inventory that they have that they're going to ramp up here, and I know that company very well. I have a long history with the name, and I just like their deep inventory projects that are coming online here, and and they've got some of the storage capacity in the Gulf Coast. They've got the Transco pipeline. I like all that combined.
And Robert, what do you think? And then we'll finish off there.
I'm kind of stuck owning them because it's in my income portfolio. It pays the bills, and so I have to give them the benefit of the doubt. But also, they're still nowhere near the top that they were at 10 years ago. These MLPs, when they were not earning their dividend and overpaying out distributions, and I think the 8 to 10 EBITDA multiples were 12 to 14 at the top in an absolute sense for them. So they're still nowhere near the top.
Yeah. I will say, I don't know if we're going back there. The euphoria. I mean, I remember flipping IPOs of MLPs and it was up 2-4 points. It was like, back then it was like the hot growth sector, and it was the amount of capital that was going, the capital markets for energy back then was wild. But paying out more dividends than you making cash flow is not really a sustainable thing. So those were heady valuations. But yeah, I'm with you. So those are kind of like holds, but they are getting a lot closer to.
I wouldn't buy them up here, but I still think I still have 7, 8, 9% dividend yields when I look out a year for 2026 dividends, because we've all sort of known what's going to happen. They've all announced what's happening for 2025. So I still think that's good. And if interest rates ever go back to 2%, which will be the new zero, they won't go back to zero, because the idiots at the Fed have figured out that, in a crisis, when you take interest rates to zero, you don't keep them there for 6 years, right? We hope they figured that out. So 2%. So if you have it, in the next economic downturn that Charlie and I forecasted happening last year, it's going to be, these 7 and 8% dividend yields, and are going to be very attractive in a 2% Fed funds rate market, in my opinion.
And that's right. I have spreadsheets. You do that dividend yield minus the 5-year yield, and that's kind of like the normalized excess yield you're getting on those things. All right. Well, I think that's about enough for today. It's always fun when the three of us get together and talk about banks and energy. All right, guys, thanks. Join us again, Wall Street Beats. Come check us out at wallstreetbeats.com. If you want to see more notes and research, we'll catch you tomorrow. Bye.
Okay.